What's up? Good morning, everybody. Hello, hello, hello. Morning, friends. Did y'all have a good Fed day? Tell you, traders here killed it yesterday. I'm talking about a lot of people in chat. What's up? Good morning. Good morning. What's up, friends? You know, a lot of people last night, yesterday, were writing me and just like blown away. I planned that trade out. My short-term calls, my long-term puts, the trade pretty much couldn't lose unless the market went absolutely nowhere. Spread netted like close to $3,500 on the long side with a $1,000 hedge on it. The hedge is probably going to be worthless, but that's okay. The whole point was to have a hedge. How those options play out? Was driving, no trades for yesterday. Yeah, pretty much. Was it like, yeah, something like that. Had long dated out of the money puts, which I still have, by the way. And the market decides to sell off, which it likely won't. I've got puts in my pocket. Cheap long dated out of the money puts just in case the market blasted up, then sold off on a disappointment. But last night we had I think it was Hong Kong. Somebody else cut rates last night. The Asian markets. It was Hong Kong. News here. Good morning, good morning, good morning. What's up, guys, in Zoom call? How you doing? Just trying to read the news. Yep. Hong Kong cuts rates for the first time in 4 years following the Fed's footsteps. Not bad. This is good. This is good, right? So the market. We have to listen to Jay Powell. You know, give us a bunch of fluff about, you know, the labor market's looking great and stuff. All my eyes at that. You know, he's being a little overly optimistic about, or like, sorry, not. He's feeding into overly optimistic Wall Street. And the labor market is not that hot. It's not terrible, but it's certainly not hot. Let's just be real with that. It's kind of slow. It's like a little sizzle. But, you know, they have to simultaneously balance, you know, two things. They have to keep inflation down, the employment situation up. So but the trick to that is, you know, you keep Wall Street happy and companies are happy and they're going to spend more money and hire more people. But The more people do that, inflation tends to go up. So you can't push the market up too high, but it's like a whole dynamic. Anyways, let's see right here. Let's get our DD bands here. 56.90. Okay. Stable still. Okay. Market prep. We're way outside the DD bands already, like way outside. So, me, I don't usually trade up here. I don't fade it. God, it's like way out of bounds already. You can see 27, 652. Really? That's what it is? And it certainly is the case. All right, let's look at the overnights. That's nuts. Like we went pretty hard on that, and then market's just been going higher and higher and higher. High SPY 56.78, way out of bounds. So I'm probably not gonna be doing much today, except for scalping if I find it. 78 is here. $667. Oh yeah, that's just way out of bounds here. Nasdaq real quick. $18,777. Dude, this is nuts. 848. Big moves almost always happen overnight. No, not necessarily. I mean, it can happen. It can happen overnight a lot. But the market doesn't really usually have big moves up. That's the thing. The market likes to move up constantly and move up slowly, but it doesn't like to make big moves up. YouTube, friends, hit that like button. Everybody here on YouTube, hit that like button. Come on over. Give us some love. That's the rule every morning. We're gonna see 50% likes to viewers, and then we'll show the screen off. Meanwhile, we're real time in Zoom. YouTube has a 30-second delay. We're real time in Zoom. Give us some love, friends. Looks like the big move today happened overnight simply because in Hong Kong also have rate cuts, right? There. Huge rate cut. Yeah, well, we don't have bands because it hasn't our table broke whenever CME changed their website. We have a web scraper that we wrote that gets that information for the bands. And so we repaired it, but the problem is the person that repaired it did a shoddy job because they only repaired the numbers. They didn't come repair the month and the ticker and all that. All right, market's open. Let's see. We have a BLD up on SPY here. All right, we're up door. We have a BLD, DD bands as well. So in BLD, which is interesting, typically reversal signals almost always come from MHP. This is usually I always usually reverse this. Hold on one second. Let me change my DP on my mouse. Okay. There we go. I usually always reverse MHP with, wow. So actually, resilience is being negative. Okay, this might retrace actually. So this is probably a decent short setup for the day. Interesting. What's up, guys? Friends on YouTube, say hello. Hit that like button. Quiet today. I'm just I'm over here working on. So today, TwitchCon starts today. Does the MHP account for the overnight move? It accounts for where the options are and the price of those options at the open. So it accounts for everything. So right at the open, when we do the calculation, definitely does. So today, I'm looking at this. In general, we have the S&P has a reversal signal. 57.2.5 is a reversal signal. With the DD resilience less than 0, it's likely to reject that and resist. So today's a down day off of that high. I'm not going to short the open here. Oops, but let's take a look at this one. Sorry. I'm trying to get the DD table fixed. Nasdaq on the other hand has bullish signals, so it's kind of interesting to see both of them. So Nasdaq itself, we have open. Orange open is a trade or taking. So as the S&P pulls back to half gap, Nasdaq's going to pull back to MHP, and they're both going to get a similar long signal there. So if you see like this, Nasdaq is probably down then up. There's definitely not a bear signal right now with this DD ratio being so high. But the S&P is that same kind of boat, kind of like that. So there's downward pressure and upward pressure. So this is the range to trade off of today. I don't normally bet the MHP breaks, but if it does break to the upside, I don't fight against it. I don't try to short and hope that it breaks back down. Typically, hedge pressure breaks are gamma squeezes up, and I usually chase. Like essentially, I'll normally chase. Now, being outside of these DD bands, dude, I don't touch this. Usually, I don't like to trade outside of here with anything. There's some stats for you guys, and this is from our Zoom call if you haven't checked it out. A second. is the stats of this particular setup here, and that kind of coincides with where the DD bands are as well. Roughly 3 to 4%. It's like high 3%. 4% of days were above those bands. 8% of days were below. And 88% of days were in the middle. So for the idea that we break through the bands, keep going, only about 4% of days are like that. Doesn't mean I short it back to the middle. But it does mean that it's very rare for this to happen and sustain. But we have moved on news. This is a Hong Kong rate cut. So the market is moving very solidly on interest rates going down, right? So this is big bull for the market. If not only are we cutting rates, but the FOMC is committed to cutting another 50 basis points by the end of the year. That's actually very bullish. So 5780 yellow line S&P, which is right here. Yeah, that is another level we need to put on here. So usually outside of the bands in that 4% range, I don't like to take a lot of I'm just answering member questions of people trying to sign up and stuff. All right, so let's see what the monthly maps are saying today. Yeah, it's a little bit of a resistance pressure. There's no longing here at the top. Obviously, there's no sell-off pressure either. The market is pretty solid. But let's go ahead and see what the monthly maps do say, because that's really important. Let me pull up the cheat sheet. Bull side, bear side. Here, bulls longing more. Bears exiting positions. So it's pretty much solid setup to be bullish. Now, what's interesting is that going into FOMC, you did see a little tiny bit of resistance being built, puts being put inside of here just in case. The market responded poorly to that. Obviously, the upset we talked about yesterday, that the market was going to be upset by the FOMC. But the thing was that the announcement came out to hit expectations, but then further, there was going to be aggressive rate cuts, which is what allowed the market to push higher. So right now, there's still a little bit of kind of bearish resistance being put inside of here. This is new. This wasn't here yesterday, right? This is at the end of the day. So basically, people started locking in large amounts of puts very near the money, just in case this were to collapse. So this will be interesting to see. These are illiquidity pockets, which can lead to volatility. One can see this as well. Possible volatility, possible big days going forward, which means the market can have some pretty sizable days, whether they're up or down. The volatility is kind of going up over the next 2 weeks. So maybe there's a little doubt, but I don't feel any doubt on the market. I feel like it's pretty strong. QQQ is like in a similar boat. Just some volatility inside of here. And QQQ is not really showing a lot of signs of that same strength that the S&P does. It's like kind of chopping all over the place with resistance. It's not really as clean. So, yeah. So I think today pullback sell-off day just a little tiny bit as I was mentioning earlier. Let's see if it's still selling. Oh yeah. So there you go. You know, basically with the resilience less than zero, the market's going to seek that half gap push like I drew earlier, but likely support somewhere in here. You guys know that's always a push right here. These are your pivots today. 564 on SPY, 572.5. Probably not going to break that. Probably not going to break this. The thing is, Lee, even though if MHP res is negative, I still don't bet on MHP breaks when you tap them from the top. So today, I don't normally do future trades outside of these bands, outside of the DD bands. So right now I'm just kind of like, S&P continuing to sell off a little bit down to that bull zone. QQQ about to hit monthly hedge pressure. This is the first bounce point. So normally, like I said, outside of DD bands, I don't like to trade. This is where markets are pretty much random and crazy. We push so high on the S&P as we've traded up here. I don't trade inside of here. There's really nothing new. If I do, it's small at all, and it's only longing. I don't ever fade the market when it's that bullish. This is probably the low bounce point. Wisdom King, let's go. Made almost $1,900, about 15, 20 minutes. Oh, hell yeah. Hell yeah, hell yeah. Now, one thing I might actually do is I might actually take a little tiny long scalp on MHP on Nasdaq. Right, as you may see, is that Nasdaq resilience is, MHP resilience is negative. So the probability that we break is higher. So what I do is I bet smaller. I still don't bet that MHP does break. Usually hedge pressure is almost, MHP is almost always a reversal. Imagine that you normally would trade this with a medium position or a small position. Whenever you don't get the confluence you want, you cut that down to like a smaller sit out. So essentially, this is like a very small trade. You're already outside the DD bands. Market's already irrational. So anything here is like a tiny little scalp. And I might actually take it just to demonstrate it. But small, I'm talking small. I'm going to do like micros for this one. Right? Let's just do. Right? Yeah, nothing crazy. Hmm. Hmm. Hey, where's the DOM? Wait, you can't do micros in eval? Did I type that right? Oh, that's right. Here I'm thinking. Here I am thinking. Not even thinking. This is still the elite trader funding thing. I guess you can't do micros. I don't know. Did I do it right? I typed in the micro. It didn't show up. The dom didn't show up. That's weird. Let me try this again. MNQ. Select. Why is there no dom? Can you not do micros? Oh shit, that's why. Z5. Okay, thank you for telling me that. My brain's jumping ahead one more year. There we go. That would make more sense. It's like, you know how many times I've done this actually really trading? A lot. Sometimes. And what happens if you click that buy or sell button, you immediately will lose the eval. I've actually done it before. It's really funny. When I first did the Apex challenge thing, I had typed in Z5 or whatever, or U5 instead of U4. And, you know, the bid and ask is like this. So, you know, you buy at the bid and then immediately you're upside down. You're upside down and below the account. So the funny thing is, yeah, so it's a little bit fun. I put in the wrong one. So the funny thing is that those contracts aren't really trading. So the bid and ask is so far away that just buying fails the eval. So it's like you click buy, you're down whatever it was, $2,000, and all of a sudden it's like buy and the eval is going. I'm like, wait, like there's got to be some kind of a glitch. And then I realize I typed in 5. Why did I type in 5? I'm such a noob sometimes when it comes to these kind of things. So the 20 Apex still there, but we have a partnership with Elite Trader Funding now. So as of like 2 weeks ago, they wrote an article about us, which was really awesome. And so now I am officially trading their stuff like going forward. Like no longer repping the Apex stuff. And by the way, we get a discount with ETF if you guys do want to use them. So unfortunately on the stream I will be showing ETF going forward. They're a great company. I love them a lot. I think they're still having a sale over there. Let me check the eval section. So it looks like their sale is over, but we do get a discount for them. I think it is hold on, let me double check. Look at that. It is 20. Oh, so we get a permanent 25% off. So here's the code if you guys want it. So 25% off. Like I said, I'm not doing this for like the kickbacks or anything. I think we do get a cut of that. I think they're a good company. They're up and coming, and I think they're going to be growing pretty quick. That'll give you 25% discount. Oops. Actually, I forgot to put the link in here. Dude, I've been so swamped. I'm like 25% off. That's kind of too much text at the top. Let's just do like this. Let me double check that. Hold on. Rocket Scooter is the code. Let me double check that I have the right link. Oh, that's from 2023. Yeah, ask him real quick. Maybe I have the wrong code. Hold on. Let me double check this. Oh, let me let him know. What is my... Okay, maybe I'm using the wrong link. Rocket? Let's see if that's it. Maybe, hold on. That is the right link. It's just not showing the discount. Let me see, and what is... Maybe the promo code is because have to be signed in. Yes. Okay, let's just try to buy one with rocket scooter code. Yep, you have to type out code rocket scooter. You have to type in the code. So maybe it's not the link, but yeah. So we'll do this. Good, that's better to type. Code settings. There you go. There we go. It's the code. It's not the link. So don't do this. Code. And somebody's been egging me on to go to do the Top Step thing and try to get on the Top Step leaderboard since they're having Michael Paddock's new marketing technique is to call out all traders with the contest. You know me, I'm like Marty McFly. You calling me Yella? You calling me a chicken? Nobody calls me chicken. Not me, but calling out all the traders. If you're a trader, who's somebody? We have all the best traders on our leaderboard. I'm like, you don't, but you could if I applied myself. Oh, you know me. I stepped up for the Robbins Cup when everybody was yelling, screaming at each other. It took me like 3 weeks to hit that leaderboard. Found out half the people were lying. They didn't even enter it. They were just talking about it for the ratings. And here I'm the one that's like, well, let me go ahead and enter it. Hemorrhaging money on those commissions. Oh my God, it's like up to 40% sometimes. Especially when you're trading micros. You can't really effectively commit to that for a year. I was committing that to beat other traders though. And then I just kind of sort of was like, well, I'm getting bored with this. Nobody's here. I came up to dance and beat some gurus, but now the Top Step thing is interesting. I can't stream it though because I'm only gonna stream ETF, but I'll see if I can't get that leaderboard. I don't even know what the rules are. Apparently there's a leaderboard. It got you 50% off? Not 25? Oh shit. Okay. Cool. Well, that's even better. How about that? All right. Well, looks like I'm cooler than I thought. There you go. 50% off. Well, how about that? Woohoo! Okay, that's good. What are the payout rules? Because Apex was a failure, didn't pay because of DCA 2 times in a month. Yeah. So I hear that about Apex a lot. Let me check. Let me find those rules here on the FAQ. What are the rules? Account rules. Okay. Let's take these over here. So to pass the eval, you go into what's called the elite account. How does trailing drawdown work in one step funded accounts? And then they have that kind. Okay. So they mark it on unrealized profit. When your profits equal drawdown plus 100, then you no longer have a trailing drawdown. It will be removed permanently. So the idea is that you have a trailing drawdown that follows you until you get to $100 over your drawdown limit. So 50K elite with 2,000 trailing drawdown is an example. As soon as you hit $50,100, right here, as you see, your trailing drawdown stops and becomes a fixed drawdown, which is great. So essentially you convert your trailing drawdown into a static account, which is great. And it's marked to the unrealized profit. And your drawdown will stop trailing. Can't trade overnight. I don't know how many days you have to trade to be able to qualify for a payout. I need to read all this, by the way, because I haven't even... I just started doing it, so I haven't got to the stage. Normally, I would read up on this when I'm at this stage of payout side. Any days you can place a trade. It's an active trading day. We'll qualify. Okay, so a trading day is any day that you can trade. Sunday and Monday account is the same trading day. That's just future stuff. So what qualifies you? So you can't just buy a contract and sell it really quickly, like just to knock down that counter. You need at least $200 in profit, and or I don't like to say and or. It's and a realized profit that equals at least 23% of the best ATD will count. Okay. So for some of the smaller accounts, it's $100 that makes the trade count. Okay, so let's do learn more there. Can you trade during news? Yes, you can trade during news days. So the 40% rule is not a thing anymore. Is not applicable to accounts purchased or activated. So this is that the what I call like the explosion rule. Like basically like you can't just you can't just like go in there and just YOLO a trade and then get your payout, right? You have to have like an average where essentially that one single trade can't be more than 40% of your account. If that trailing average is above 40%, you don't get paid out. You have to keep trading until you bring it down. Consistency rules. It only applies to sim-funded account only, but that's interesting that says it doesn't apply anymore. So maybe they got rid of it. So, Abra, we have our company now has like a partnership with Elite Trader Funding. So we're actually going to be showing their services off kind of going forward. And the minimum profit per day doesn't count for evals. That's actually really good to get rid of that 40% rule. That's a competitive advantage right there. And they'll let you trade during news. That's actually pretty cool. So they're going to let you... Oh, nice. I switched over to doing ETF like about 2 weeks ago. We were like waiting to finalize details of a partnership that we have with them so that we're going to start using their services going forward. And I've been hearing a lot of horror stories about Apex, like not paying out. Even if you follow, I've seen way too many of them online. Now again, not speaking anecdotally, no experience here, so no bad mouthing Apex or anything. But there are people that have posted P&L curves that show they followed all the rules, they did everything right, but then they were denied payout for mysterious reasons, like they called shenanigans on their trading strategy or something, when like the person was like a really solid trader. And they were denied payout without technically beating any of the rules. I saw that twice on Twitter. And I was like, okay. Like somebody actually beat the system but didn't get a payout and followed all the rules. And that to me was kind of... Now again, that's their testimony. Not any physical experience with that. I didn't verify it was authentic or not. But I saw that a couple of times and it kind of was like, okay. So hopefully they don't, hopefully they pay out. Who knows? They want you to video yourself as trading as proof for a payout sometimes. It's ridiculous. Oh, God. Somebody in Zoom was saying they actually want you to journal the entire thing. They can ask for it whenever. Journal your trading. With all that effort, you might as well just be really trading a real account. Interesting. Okay, so today, it's hard to say what's going to happen. Remember, we talk about there's no shorting markets outside of DD bands. I never short till they come back in. Here's an example of that. Remember, I talked about, I drew this morning. You guys remember? That was the SPY one. We drew this morning. I still didn't take it. Where's like high of day, low of day? Nasdaq had a nice bull signal. We always bet the MHP is a reversal signal. Oh, SPY today, basically, yeah. So MHP is always a reversal signal. Always. Always. I always reverse it. No matter what. This is your range. High of day, low of day. So inside of here is a big range. And this is huge. This is 80, 90 points. It's big. I don't think we sell off today, clearly. But the S&P resilience is definitely very low, and we know how this works. Now, remember, when you're outside of the DD bands, market's irrational, so you don't use resilience as a leading indicator. So the idea is that the stocks can immediately catch up to this. But what I would do personally is right about here, I would fade some of this from yesterday, and just with a really small bet. But it has to be from MHP. All right, let's do some numbers here on this one. Okay, let's get some more red lines going on here. This is my full history of impact and run lengths. Let's do this one. Monthly expiration is in 2 days. Today and tomorrow. It's a big Friday. I don't know what. Oh, this is just randomly sitting there. Okay. There's your Hong Kong move. So let's pull up let's get some retracement targets, just in case there is any downside. Now, typically if you don't sell off on Thursday, it's very rare you're going to sell off on Friday, a monthly expiration. I don't see that happening a lot. If it's going to sell, it'll sell like the last 2 days or so, but it's very rare that you're going to see that last day just reverse. Usually we'll hold the fort. So if you're betting on the market selling off by tomorrow, it doesn't look like it's going to happen. Oh, this market just so strong and bullish. Futures breaking all-time highs again. That's good. Somebody said Apex wants you to journal the entire thing. Why you choose your level and your reasoning. They want it all. So they basically want your entire strategy too. That buy spree on Apex that you did was a failure for real. You don't even care about the money. It was the time invested that hurt. Wow. So a trader on X showed how Apex requested the trades to be recorded. Oh my God. What up, Irrational? That much support in UPAX. Hard to sell off until the expiration on next Tuesday. Yep, 100%. So I don't think we'll see any kind of pullback into today, tomorrow. I think the market's going to stay long and strong. Kind of honor the high of day and low of day, though. I don't think we get a big blowout from here. The market's already moved way too much. I think we close somewhat higher. Or at least attempt somewhat higher. There's that. But like I said, the retracement or reversal is not to sell off the market. Essentially be today's opening move. If anything, there's a little bit of a scalp there. If you get lucky, it can do this by the end of the day. That's only if you get lucky. And that's a lot. It's like 80 points. And if it sells, R&R is huge, but it's not really worth... I don't take a stab at it with anything. I usually don't trade outside of DD bands like this. I'm going to hit it with an eval again. Anytime irrational markets, I'll just try to pass another eval or two. Those Apex stories have you worried? Don't want any issues getting a payout? Like I said, my goal was to test to see if they did pay out, and I'll still like let you guys know in the Discord. You know, like if that happens, like I can't stream it anymore, but I'll let you guys know if I have any issues. Yeah, like asking people to record it and journal it, and like it just is the state. And here's the thing, it's like the state of the funding programs, and I see them all on social media like arguing with each other. They're kind of all teaming up for the industry, but they're like arguing with each other, being hyper competitive of like, you're not really testing trader skills. You're just letting them do this, and you're letting them pass an eval in one day. How is that even, you know, Like they're saying like, I have more integrity than you, blah, blah, blah. And I think it's a joke because, listen, for your business model to be able to pay its employees, you must make money. And when your only source of revenue is people paying to fake trade, in minus out equals accumulation. So for your company to make profit, you must design your business so there's more losers than winners. Exactly the way a casino does it. So I don't understand the idea that the surface level publication is like, we have more integrity than you do. It's like two casinos saying we have, you know, like one of them's like, I heard somebody on social media last night, some influencer was like, we have more integrity because we really care about traders. We really want to help them out. It's all marketing. The business model, the risk model is we need to make it hard enough so that the failure rate goes up so that we make more money than we pay out, that we can afford to pay our bills and make a profit. Their only source of revenue is literally that. And Tradeovate, the rubber stamps this whole thing for all of these different groups that do this, has a huge overhead for them. You pay like $25 to them per user account plus $5 for each additional account. So you need to overcome $25 of overhead plus data feeds just per user, and then their margins are razor thin on top of it. So the failure rate needs to be very high for them to pay their bills. I don't think any of them are really caring to educate or allow traders to pass. The only time I've ever met a company that has talked about wanting a trader to pass was Elite Trader Funding. When I had a talk with them, they said, Matt, it would be so cool if we told people that they can learn how to trade through you guys, and that way we can help them pass. We really want people to pass. And I was like, that's a little counterintuitive. I was like, that's counterintuitive to the business model. Don't you guys, and let's be real, don't you guys want enough people to fail so that you can pay your bills and pay your overhead? It's just like a casino. Let's not pretend that this isn't like a casino where the house is the odds. And they're like, well, yeah, I mean, there's no way we can operate at a loss, but we're not trying to do things to not pay traders out. Like a lot of these companies don't pay traders out. And I said, okay, well, I'm seeing that on social media. Like a big blowout win. They create all these rules that don't allow you to have these big blowout wins because they don't have the cash flow to pay out. And then they delay by like, do you have a video? Can you send us that video? Okay. And then you have to send the video. Then they argue with you. Then they finally pay out. That's just a delay tactic. That's a checks in the mail sort of thing. Do you guys understand that? That's what the industry is really like. It's a casino. So it's not like it's a dirty industry because it's a casino. The odds are not in your favor. It's designed so that everybody loses, and you have fun while you're doing it. You know, you're preying on the hope that you're going to get paid money. It's just like a casino. And if I just win that one blackjack hand, my life will be better. Most people are just using it as a practice environment, right? But for them to argue like, we care about traders more than these other guys because we don't allow you to pass your eval in one day. They're all fighting on social media. And I'm like, your business model is to squeeze out enough people so that you have more losers than winners. Your goal is to fail people, which is okay. Just say a rose is a rose. The rose, say what it is, right? That's the funny part. But ETF has a lot of integrity on it. They were like, we actually want traders to learn, to be committed and to learning it better. Ideally, we'd like to actually find the really good traders. So I'm like, oh, you want somebody to actually educate your traders? They were like, yeah, it'd be kind of cool if we had a thing where if somebody failed or you know, whatever, we can say, hey, look, check out Rocket Security. You can actually learn how to get better at this. And we think that's great because we want traders to be committed to our brand, committed to our product, and actually get better at trading. We want to have a longer relationship. That's why we may make you wait a while before you get paid out, because we want you to stay with us for a while. And I was like, of all the things I've heard, that is the most honest approach, I think. Because at the end of the day, they're like everyone else. They have to squeeze enough people pay their bills, which there's no harm in that. The casino has the same business model. If everyone won, they wouldn't be in operation. So that makes sense. You're playing the risk game. It's just like trading. For someone to lose, someone has to win. But in the eval world, more people have to lose than winning. It's not a zero-sum game. The house ultimately wins because they're the ones making the profit. Makes all the sense in the world. It's a healthy business model. But I don't like the people on social media trying to like tell you, we care more about traders than these other guys. And they're like, well, I'm sure you care, but I mean, it's not like, it's like you're everyone's skipping over the fact that it's like, don't mask it like we're gonna help more traders win if you're not really helping traders win. ETF was the only one that told me like, hey, we're trying to help more traders win. I was like, that's actually kind of cool. You actually want to educate people so they get better. I would feel like in that business model, you wouldn't want to educate anybody. You would hope that they just don't do well. So I kind of found that to be very honest, and I actually like that. And I also like the people that work there. So I was like, we should work together. This would be great. I believe in somebody that says they actually want to educate traders. Maybe they make less money than the other guys. Maybe they don't grow as fast as the other guys. But to me, that's the one that's going to have the staying power, I think. I was like, yeah, let's work together. So, Chase, you don't use... Chase, have you come to any of the Zoom calls? I'm not going to teach you guys in the YouTube, but do you come to any of the Zoom calls? Have you been? That question was answered like in the third video. It's actually in the old training too. You don't use resilience under certain conditions. You just don't use it. And that's a rule. You have to learn when you use our tools. That's one thing too that I want everybody to understand about our rules. You don't apply everything all the time. I know you've been around for a while, but this is something you should understand about resilience. Let's see if anybody in chat will quiz you guys. I want you all to come to the Zoom calls because we're very clear about when you do and don't use some of the things. Someone in YouTube or someone in Zoom, when do you not use resilience at all? You don't use it. There are times when you just do not use it. Not irrational. No, that you're 2 years behind. You have to come to the Zoom calls. We've upped our strategies. Our strategies a lot more refined than just that. There's two specific things. Yeah, and people in Zoom are getting it right. Livewire's got it. You don't use resilience outside of DD bands, and you don't use it when a catalyst is active. That's it. You just don't use it at all. You don't use anything. When you're outside of DD bands, you don't use that. You don't use that. And you don't use that, but you still trade off of hedge pressure and bull zone and bear zone. See, the thing is like we evolve as a group. Our strategies get even more higher, more techniques, higher probability setups. And so today you wouldn't use resilience at all because the irrational side of a structure break, you can't assume that the index is following the stocks. Clearly, there's a discrepancy between the two. And you can't assume that the stocks will move first when DD bands are broken or catalyst is active. Chase, you got to go to the Zoom calls. I'm not teaching I'm not teaching here in the YouTube anymore. So the new thing is that YouTube is no longer an educational thing. We're about to switch formats to a show. I'm no longer going to be like live streaming trading on YouTube. So we got to go to the Zoom and watch those recordings because it goes over this pretty clearly. But yeah, you got so the new techniques it has all new graphics, all new everything. And if you guys want to support that, it's only $1 a day. So the new goal is to raise some revenue to hire some more developers. So that these probabilities and these new things can be on the chart. We're gonna re-up our strategy, UX and UI. So the probabilities will be printed on the chart. Reversal probabilities, bull zone probabilities, things like that. And also, the part of the AI assist is to tell you when certain conditions are there to physically remove the indicator. Like to gray it out or say it's not active. So that would be like the final step of the newest thing we're trying to build. Yeah. But today, resilience and DD, scrap it. So just like technical analysis, you use indicators all the time, right? Up, down. Ours are highly conditional. Under specific conditions, they're leading indicators and they are amazingly high odds. Rational market, DD ratio greater than half. Look. With the rational market, with all these lights, you know, since we don't have our rollover fixed, those are actually red. But imagine that everything was green. You hit bull zone bottom with this greater than half. In certain bull markets, when you're up, when you're basically going straight up and below triple B. So essentially, below triple B, this greater than half, this here, this has almost a 90% chance of holding. Under those conditions. Under other conditions, like irrational markets and things like that, it's closer to 60%. Bear markets, etc. Like the overall probability is considered 60%. 90% under the best bull conditions. All conditions is 60, bull is 90. So even bear markets is still 60%. So it's a great odd, right? And that will hold through any irrational market as well. That bull zone bottom is a buy no matter what, right? Yeah, so I'll be teaching options starting this next week. I'll be teaching how I trade options. Demonstrating that. There's another rule. Again, there's things that we always do. It's a whole different strategy application. It's pretty much the same strategy, but the application's all different. So it goes through which trades I do take, which ones I don't take, and how much I trade on them, and the conditions that go into it. So like today, outside of DD bands, it's a sit out. I might reverse monthly hedge pressure. I usually always do. That's why I'm waiting for it to tap. Yep. So everybody in Zoom is getting it right. When DD band is broken, when a catalyst is active, you don't use resilience. I'll type that in there, just as a reminder. So we're summing up all of our techniques into a 20-day webinar of like all of it in one thing. So just a reminder. Don't use resilience. I'm typing it right now. Okay. So these are like basically the irrational rules was a blanket set of rules that like prevented using certain things. It used to be when markets are rational, in general, we didn't use these tools until we had enough data to support an even more refined strategy. We use some things under some conditions. So hedge breaks and things like that are no longer irrational enough to cause me to throw everything out. Man, that stream elements finally kicked in like hours later. Why is that bot listening to that? Yeah. I just think it's interesting that the prop firm industry has gotten really big, and I support it. I think it's great. I think the industry is really good because what it does, it gives traders a chance to feel the pressures of a trader without having to risk a lot of money. Why would stocks go up while the VIX is going up? They indicate more people are buying calls in general, more premium. No. Great question though. You always make me do this. I usually get about 10% viewership drop every time I bring this up. Here's a technical paper. Here's a technical paper that allows you guys to see how the VIX is calculated. I love saying this, so viewers don't go anywhere. I'll skip over the heavy math lesson, just prove to you that I'm a math guy. I read these things. Here's the equation of the VIX. These are all the pieces that go into it. Expiration, options price, strike levels, forward and next level. These are all options related mechanics. The strike prices, the interval between the strike prices, the risk-free rate to expiration, which is considered the risk-free gain, right? This is the interest rate that options are pegged against in Black-Scholes. And then the midpoint between the spread. See how none of this has anything to do with stock prices. The word stock price isn't even in here. So just as a quickie, it's not considered in the equation. So the square of VIX is equal to all this razzmatazz over here. What's up, IDOC Talk? You're late. What'd you miss? Oh, okay. Yeah. You missed everything. Over there, she over there at TwitchCon, repping the marketplace. Love it. So in here, while like stock prices loosely correlate to the options prices because of the Greeks can do that. Like delta is a change in the stock price. What is the change of the options price? Well, delta will tell you that. So you can kind of like know the change of prices, but the supply and demand of the options themselves is what makes options actually have a price. So the idea is that something can be like given a price and something can have a price. So the price is whatever traders are willing to pay for it, despite what the equation says it should be. Does that make sense? So like a market maker is like, let me quote this option here and here, because Black-Scholes says that should be the price of the option, the bid and ask. But if at that price, there's 1 million people buying that option at the ask, you're going to raise the bid and ask, despite what the underlying price in Greeks say the option should be. So it's like it's a recursive, like, iterative loop. The option value goes up, and then the stock value can go up, and the option value can go up, stock value, and they're listening to each other at the same time. If they're both just kind of like these floating entities that are kind of like loosely tethered together with a rubber band, and somebody buys a whole lot of one, the other one's going to slide up with it. If they're all floating here and somebody sells one, then it's going to drop, and then maybe the other one's going to like float down to it, right? They're kind of like floating like this. Looks like I'm juggling balls in my hand, but you know what I'm saying. The idea is that they have independent supply and demand, so they're going to operate independently. That's the whole point. They have their own tradable market. So it's just like why SPY, and the easiest way to describe it is like why SPY, why the SPX divided by SPY is never equal to 10. It's just roughly 10, and it changes in real time by like 1%. It's like up or down because they independently trade. So because of that allowance for them to like independently trade, they're allowed to deviate, right? They deviate by natural means. So why does VIX go up when stocks are going up, right? Let's answer that question, not that way, but let's answer the question, why instead of like, so he asked, this is a great question. This is one of my favorite lessons. Why does VIX go up when stocks are going up? It's an observation. Now let me start by giving you the answer. VIX can go up when stocks are up or down. So to answer that question, let's ask what's observably or anecdotally the case. Like why, when stocks Why, when the stocks go down, does VIX go up? Let's start there, because that's observably what we always see, right? Let's flip it and reverse it, as Missy Elliott would say. Why, when stocks are crashing, does the VIX go up? It very simply answered this way. If the market almost always is going up, as we have shown you, right? Livewire, you've been to the Zoom calls. We give you the stats on how many days go up, how many months go up, what the end of the month is like. Stock market always goes up. Case in point, we all agree. Stonks always go up. Number 2. What is going on? Number 2. Because the stock market, it looks like the Commitment Traders report is not loading up. Oh, well, let me close it down. Because the stock market always goes up, on the non-dealer side, like traders like you and me who are either longing or shorting the market, at any given time, there's always, and I mean always, under like the rarest of conditions, this is not the case. There are always more people longing the stock market on the risk side, which means they're not neutralizing their risk. They're taking risk. Of all the risk-based traders, there are more people longing the market than there are shorting the market. The market makers or dealers are almost always net short until, like, you know, the 7 or 8 times in the last 30 years they haven't been. And those are extreme conditions. So, like, basically, if you were to ask the poll America and say how many of you are bullish the stock market and how many are bearish the stock market, how many of you are shorting the market versus longing the market, most everybody would say, I'm in my 401k. That's pretty much all I do. And that 401k is only longing the market. Like, majority of traders, most of them are going to be bullish rather than bearish. So because the market is more bulls than bears, the insurance side of the market means if you were long the market or your 401k is long the market, then most hedging are going to be puts. Okay, so most of the options being bought are going to be puts. Because there's more longs. Because there's more longs, there's more puts. Okay. For the most part. And so, because the way markets trade, oops. Because the market, when it goes up, the volatility, now again, this is a little recursive. Let's just assume we prove the volatility typically goes down. But because the volatility does go down, people will buy their puts like closer. Let me start over. Puts will be like closer to price because the volatility goes down when markets go up, but because puts are closer to price, because volatility goes down, because puts are closer to price. It goes in a big circle. Because that's the behavior that's assumed. People are going to spend a little bit. People are going to, like, essentially pile their puts on top of each other because they expect the movements to be low. So it's very rare that you're going to have a market collapse, and when it collapses, it's really big. So therefore, people hedge by putting their puts really tight. They're slightly more expensive than buying them down here. But because they're tight, any break is a massive insurance buffer. That delta goes up really quick, and the gamma goes up quick, and you're good. Now, because sell-off markets tend to expand on the volatility, if you're in the mode where there's more shorts than longs, let's imagine like COVID, that's the time when this happened, right? Markets crashing. Then the calls are going to be spread out all over the place because those expected ranges are much bigger. They're not going to be like tight on here because it's almost impossible to predict that seesaw action of a market sell-off. Because the market's almost always more long than short, the upset case is the sell-off. And when the frenzy of an upset happens, everybody goes crazy and starts last minute throwing their options in. And so the last minute options are all over the place. Because they're all over the place, the supply and demand is like speckled. It's like there's demand here and demand here and demand here and like zero here and zero here. It's not like a nice, tight, compact market. It's like scattered, right? And because the options are scattered all over the place, the demand for them is scattered all over the place, VIX is going to go up. So VIX is like an equation that's like, where is the supply and demand of options as a bulk thing at? If volatility is going up, it just means the supply and demand of options is like getting thinner and wider. Kind of what it's telling you. So when stocks go down, why does the VIX go up? Because that's the unusual case. And usually options are nice and tight, wrapped around that slow moving market that goes up. When the upset happens, options just like shatter and go all over the place. When options shatter, VIX goes up. So you're asking, why do options shatter sometimes and stocks go up? There's a very, 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 very simple answer. When the market is upset in a surprise. So a nice bull market gets upset with bad news, all your VIX is going to go straight up. A big, nasty sell-off market like COVID for months and months and months and months, all of a sudden, it's a big short squeeze. VIX also goes up. Short squeezes make VIX go up when stocks go up. So all the people short the market, they get squeezed on a Fed upset. Fed's going to cut a basis point this year. Hong Kong cut rates last night. VIX is going to go up because more shorts got squeezed than people are actually longing the market. That's why it is. So while the market blasted up, it's more shorts that are covering. Because remember, when you exit a trade, you're the one in the frenzy. I love this lesson. More shorts are covering is greater than longs buying. If this was flipped around, the VIX would be in decay. But because this is the upset case, there's more people fleeing or forced to buy than actual buying. The options, the call options, are in high demand and scattered because the market is in a frenzy to the upside on an upset. Because the options on the call side are scattered, which is rare because it's usually the put side that gets scattered on an emergency sell-off. This is an emergency rally. So in the case of short covering, for the most part on the stock side, forces unusual scattered demand on the call side, which causes VIX to kind of go up when the stocks go up. You like that? VIX has no parity to the negative or positive direction of the market. It's all 100% to do with the supply and demand of the options. So as you see, VIX squared, VIX is always a positive number, right? No matter what this is, whether this equation is positive or negative, the VIX is always positive. Because when you square a negative number, it's a positive. You square positive, it's positive. VIX is never greater, never less than zero. Right? So whether the supply and demand is tilted to that scattering on the call or put side, the change is roughly dictated by this term. Well, they all work. How close you are to the money for that supply and demand to be there. Like if that supply and demand scattering happens like right now, time to expiration is very little. Like T is how many days to expire. If this number is small, like imagine everybody's buying options 10 days out, then all of a sudden they're rushing to buy options that expire 1 day out. When you divide by a smaller number, this entire term gets bigger, right? So if people are scurrying to a frenzy to buy options that expire now, rather than options that are expiring 10 days out, VIX is going to go way up despite what it is. because that T term is in the denominator, people quickly acting on like, oh shit, I just got short squeezed. I need some 0-day at the money calls right now because I shorted the market and the Fed upset me. I got to buy some calls right now. I need to buy them that expire today because boy, I'm in a short squeeze. Boy, I don't have a lot of money. Boy, I need some cheap options. Shit, I got to buy the calls now for today. They expire today. All of a sudden, VIX went up. So, Livewire, does that answer your question? It's not just more people are buying calls. The answer is yes. More people are likely buying calls. But also, because more people are buying calls and the market's going up, more call sellers are forced to buy the market, which forces more calls, which forces more call sellers. And they're recursive, right? Each moment the market goes higher, a call seller has to long, which pushes the market higher, which squeezes someone else to force them to buy more calls, which pushes the market higher, and it goes in a big old circle, and then it goes up. But in general, the VIX just goes up when there's an upset in the market. And when good news breaks expectation, which yesterday we didn't think it would, but it did. The expectation was we'd have interest rate cuts, but slower. But the Fed committed to 50 more basis points by the end of the year. That's incredible, right? And then today, our futures market moved up on another market rallying, which has nothing to do with us. So this move today is an upset to the upside, forcing a lot of people to jump in and buy calls because Hong Kong doesn't really have much to do with our economy. But why is the VIX trading up when the stock market's trading up? Right? Because right now there's an unusual demand for the counter side of options of the direction we're going in. So the market's going up and people are jumping into calls like crazy. It's tilting the balance, which is causing VIX to go up. And that happens during short squeezes. That's a long-winded answer to say that's when that happens. When does VIX go up? When the market crashes, and long squeezes, when longs have a domino effect to kick the market out. But in the rare case that a short squeeze is outpacing the natural longing of the market, VIX will also go up. Did I explain a class on partial differential equations in a way that y'all can understand it? This shit's very complex. It's not... That paper is fun to read if you're a mathematician. If you're not, it's like putting a gun to your head. It's horrible. You won't be able to make heads or tails out of it. But, you know, this thing is pretty... This is a pretty decent class on, like, examples of the equation. It's just, like, you'll bore yourself with it if you want to. But these are the terms. And typically, the term that most aptly guides this is this T. And imagine, like, the easiest way to think about it, if you divide something by 0, everyone in class, we divide something by 0, what happens? Well, even the meme, right? 10 divided by 0. You know, the robot memes like, divide by 0, right? Like, your shit hits the fan. Infinity, right? So when you divide by 0, the term is infinite. So time is the amount of time to expiration. So if you're buying options like really far out, all things are equal. Like everyone's just buying options like really far out. All of a sudden, everybody's changes their mind and is buying options like now, for now's expiration. Today. Let's say a month out. Just everybody just buying short-term options rather than long-term options. If all the demand goes from here to there, then the natural T goes, like this term goes up because you divide by a smaller number. This is the time to expiration. So like T1 is definitely less than T2 in this case. So as like everyone's frenzy is like, oh shit, we need options that expire really soon, like cheap options just to jump in on something. Not long-term, healthy, stable, ebb and flow bets. It's like, oh my God, there's a frenzy. Get options now. They expire tomorrow. Ah, crazy. Then this whole term goes way up. And so does this term. It's squared. But both of these are time dependent. So the question is, it should neutralize a little bit, but this term right here is time dependent and this term is time dependent. How they both respond to that change in time is much different. One of these is a slower moving term than the other. So the time effect really hits one of them pretty hard. That's the whole point. Is that one of them responds much quicker than the other, which causes the VIX to go up. And that term, in like the most layman sense of the word, is that scattering of the options. Is like where people typically put their bets. And again, I'll just tell you, like it's pretty easy to, even if you read the equation and you knew how to solve all those parts of it, you still wouldn't understand this part. Unless you are like, you've got a brain that has the ability to see math and then explain math in a way that makes sense. Here's how it makes sense. Let me just show you guys. And this is it. This is literally how it works. It's because the behavior. Markets that move up tend to move up nice and stable. You see how like when the market is going up and it like jolts around a little bit, it's not really that it's not dynamically that crazy. The ups and downs of the chop are smaller in an up market. This is exactly why up markets are expected to behave a certain way. Therefore, the options and a bull market are longer term and typically like closer to the money. And further out in time. Because like bear markets are ridiculous. I'm telling you, like, ridiculous. Look at this. The ups and downs are nightmarishly crazy. The waves are big. Look at this big wave of a pop-up. Look at this right here. Short squeezing right here. Look at that. Look how big the volatility is. Look how asymmetrical this is. Like, this is small, big, small, bigger, medium. And then, like, you're like, man, look at how much the market is on a bull side is nice and smooth. Other than the big ramps up, when the market is questioning itself in a bull market, it's nice and tight. It's consistent. And we can all see there's consistency, right? Because the market generally goes up, predictable part of the market that it always goes up. So typically the upset is always the sell-off case. So the upset is usually that we observe as VIX goes up when markets sell off. But I'm going to tell you, probably right here, at the beginning of August, there may have been some days where the VIX went up when the market also went up. I'm just speculating, but let's go check. Because short squeezes tend to create that effect also. Because that is the upset to that shorter term trend. Let's look at the beginning of August. What was it, August 5th and stuff? Yeah, so like days like this. Here's August the 5th. This was what we're talking about, like days when VIX are going up and the market's going up. I mean, that's that early August I was showing you guys. 5th, 6th, and 7th. So here's days, actually it's in here. There's days when the VIX is actually trading up. Right? When that market is trading up. Like this particular day, this Tuesday. Wait, hold on. Monday and Tuesday. So here's Monday, right? Market's trading up since 8 o'clock in the morning. Here's 8 o'clock in the morning. And the VIX, while it is sort of like doing this, the market is kind of, VIX is kind of going up a little bit. In general, off of the lows from the open, market is going up. So it's like, it's a rare case that you see this. But here's that day. The market is violently moving up. And here is that day where the VIX technically is moving up. Y'all see that? It's rare, but it happens. Don't read the paper. It's a horrible read. You're going to hurt your brain. But just, you see what I'm saying? Do you see how in this condition, the VIX went down and then up, and the market went down and then up? on that Monday. Y'all see this? It's rare, but it does happen. So you can't correlate. And again, this was, you guys remember this day, right? This was that big market crash day. So right when the shorts got squeezed, the VIX started responding to that. Now, it's not like the VIX is never going to like fly off the handle on a short squeeze, but it will correlate internally in that day, trading up while the market's trading up. It's kind of a cool phenomenon to see that. So you have to be careful trying to make bets that, okay, well, the VIX is going up. Let me short this market. Try not to correlate them at all. Use VIX pivots as a time to like get out of trades you're in. But the market may respond to any selling because it's slightly more volatile. The market will be thinner and not be able to buffer off that selling as easily. Like right now, these candles are like pretty big to the downside. But I never tell myself, okay, the VIX is trading up, therefore I need to sell the market off. I never really say that. Because if there are still buyers of the stock, the S&P is going to go up. If there's still buyers in the index, the S&P is going to go up. If nobody changed anything in options, the VIX wouldn't move. So they're kind of like not necessarily have to be correlated that way. So just be careful. So it's neat to see that, but it's rare. Like it's not the most common thing you'll see. So like today, the S&P has traded up overnight. Over the course of the session, the S&P is slightly down. Over the course of the session, the VIX is slightly up. See, that typically tends to ultimately find that parity, but you don't tell yourself, you know, from like 10:18 in the morning until 11 o'clock in the morning, VIX is going up, and 10:18 in the morning, the S&P still went up while the VIX was going up. It's a short squeeze. You know how you know it's a short squeeze? Because of the curvature. Short squeezes look like this. They're like S-shaped things. The market moves to a degree, and then a short squeeze is somebody is forced to buy, which forces more people to buy, which forces more people to buy, forces more people to buy. And short squeeze is always characterized by a change in concavity and volume spike throughout this part of the curve. And here's your change in concavity right here. And here's the volume spike at that part of the curve. So there's your answer. Any questions? And I always talk about, this is why I'm saying, you know, people would rather watch your favorite fun time idiots on YouTube instead of learn how the stock market works. But as predicted, because I can predict any fucking thing pretty accurately, is your 10% drop in viewership who are like, how come this guy's not shouting at the screen? Why is he trying to teach me something? Let me go watch someone who's a moron and yells. So there's our predictable 10% drop in viewer base. We bring out the VIX white paper. Just like I could predict the high volume pivots. So there you go. I love it. It's my favorite lesson to teach, though. Short squeeze. Curvature change. The bowl is down, the bowl is up. And in that part of the bowl, there's always a rapid increase in volume. So there's your short squeeze live wire. That shows you why the VIX went up during that tiny period in time. Exactly that point in time. Random, spontaneous, forced buying. So when you see this particular piece of the leg is the short squeeze. So the long answer was what I said, but the short answer is short squeezes. That random forced volatility, I mean that forced buying creates the volatility. Pretty neat, right? So big ramp up in volume. Market is, you know, people got squeezed. So likely they jumped in and bought last minute calls, which forced people to buy, which pushed the price, which forced people to squeeze, which pushed the price. And then whoever was upside down had their limit there and finally got out of the way. Yeah, and that's it. And now the VIX probably from this moment in time from right exactly there, the VIX probably got back to correlating. So probably exactly at 1034 and onward, the VIX is probably going up as the market's coming down. So let's look at 1034 VIX. Once that volume goes away, the market's back to being predictable. And at 1034, which is here, the VIX is likely going up when the market's coming down. And there's class for today. And I'm going to get out of here on that note. You see how cool that is? So here, again, 1034 was the moment that short... So the short squeeze was here. Remind me today's Zoom class to go over that. That was your short squeeze. VIX went up when market went up. Wait, what? And the VIX went up when market went down. This is the squeeze. This is the normal. Pretty neat, right? Okay. All right, I'm out of here. Got a lot of work to do today, you guys. Thanks for tuning in. No trades outside of DD bands. You guys know the drill. I don't do much here. I was looking to fade MHP. We didn't touch it. You're there on S&P 572.5. I'll put some short futures trades into that. We'll see y'all later. Our Zoom program, only $1 a day. Go to rocketscooter.com/Matt. The link above. Or you can get the full Pro Plus package. Everybody, we ask you, join. It's $20 a day. We go through the Zoom call. All the probabilities of these setups. Teaching in the market. One trader at a time. One of the biggest trading communities there is out there with 6,000 paid members and growing. 4.9 out of 5-star reviews. People might go read those reviews, see what people are saying. Love y'all. See y'all later.